Ed Dolatobodi. I have been in real estate for the last 15 years. I've been helping so many, I don't know the number, of families, individuals buying their dream homes, selling their homes, doing all of those real estate activities that they have. And I love it. And from what I see, I'm going to be doing this for the rest of my life. So that's for me. There are my team members, Noah and Stephanie here, and our wonderful mortgage broker, George Glasaris, is here. So I would ask you guys to introduce yourself as well.
Hey guys, my name is Noah. I'm a real estate agent. I work with Ed. I've been working in real estate for about 4 years in customer service, pretty much all my adult life. So I love working with people, and now I work with experienced Ed. Let's enjoy the webinar.
Great. Thank you. Thank you. It's good that you said you love working with people. And then you said I work with Ed too. So it's a good one.
I make that in person.
Special person. Special.
Thank you. Okay, go ahead. Who wants to
I'll go next? Hi, guys. My name's George. I'm a mortgage broker. Been a broker since 7 years, 8 years now. Prior to that, I was with CIBC and RBC as a financial planner since 2000. So been in the business quite some time and understand both sides of the balance sheet. So when we talk about credit, I can also talk about investments a little bit. So my approach is that from a financial planning perspective. So I like talking about numbers and budgets and all that. So hope you guys enjoy the presentation.
My name is Stephanie, and I'm the admin for the real estate team. And I've been in real estate in a few different sectors of it since 2004. And I absolutely love the culture and the energy, the whole process of helping clients get their needs met through the whole transaction. Basically, what I focus on is making sure the ball doesn't get dropped. So if you need anything, you can call me and I will point you to the right person. There's no need to stress. There's no need to worry. Like if you just get in touch with me, then I'm going to make sure that everything is handled. And tonight I will be the moderator. So I'm going to go ahead and turn my screen off. That way I can work in the background. But I hope that you all have a great webinar.
Thank you. Thank you so much, everyone. The intention of this event is to provide you with the kind of information that when you leave this event, you have enough information to know about how the process of purchasing goes, the mortgage as well as the purchasing. And you leave here with enough information to make a right decision for your purchase. Okay. So the agenda of tonight is number one, understanding the market, 2 factors that affect the home value, 3, the home buying process, 4, mortgage approval, number 5, buying costs, and then lastly, we're going to have a question and answer session. Number 1, understanding the market. So how do markets behave during the times of change? You might have seen in the media, in news here and there, that market is like this, market is like that. Our goal is to help you clarify what's going on by reviewing both macro markets and micro markets. This is like a general performance of GTA. From 2017 until February 22, you can see that this graph was having a very normal ebbs and flows up to here, and then all of a sudden it just goes up. And this is the COVID hit. Basically, it was half of March. First half of March was crazy. Second half was completely dead. Then April, and then as soon as things started to open up, market caught up again and going up and down. It's normal, like we have peaks and valleys in Toronto real estate market all the time. And it depends on the season and what other stuff that are happening. Like here, what was making a big difference was, you see this drop here is post-COVID, is because it was summer and people were, a little bit, things were opened up, people could travel, so they were not doing much. But then again, it just came up. And this jump from December, which was a very high December in historic December, this jump from December to January and then to February is very unusual. It's going up like crazy. Now, I don't have a crystal ball, but from what I see from the first 10 days of March, I could somehow, with some kind of confidence, say that it's not going to go at that pace. The first 10 days of March for you, if you are going to be in the market to purchase right now, I would say there is more opportunities. In these first 10 days, that the numbers are not there, public are not aware of it. They're still talking about all prices are going up. To me, I have seen a softening in the market. The number of people who are putting offers on, they're coming in multiple offer nights, let's say from 10, 15 offers has reduced to 4. I'm not saying there's no multiple offers, but when you go to a multiple offer situation, there are 15 people, or I've been in a situation with over 30 people, but anyway, it doesn't matter. When there are 15 people competing, the prices are not going to be the same as the time that there are 4 people competing. And in some cases, I've seen a few listings, like not a few, like a considerable number of listings that last week they had multiple offer night and they didn't sell at that night. That is a sign that market is softening and it's going to be a good market for buyers. Talk about numbers. I love numbers. And I can talk about numbers to basically probably to midnight, but I know they're going to get bored. And if you're like me, and if you wanted to have a conversation, we can always have that maybe another time. And we're going to our next slide. What's in the news, basically? People react to what they hear in the news, in media, social media. And one of the things is the headlines. You read something and you read a headline and it's like eye-catching, feels like the sky is falling. But if you read the whole thing from the top to the bottom, you realize that no, the sky is not falling. And whoever has written that article just they wanted to grab your attention. They just go up and down. The market is going, this part of it is good, that part of it is bad, blah, blah, blah. And then at the end, they come to, well, things are okay. Oh, okay. But like from the headline, it didn't look like.
Yeah, those are great points, Ed, because the media definitely plays on people's mindset, especially, and I guess from a mortgage perspective right now, the rising interest rates has been in the news, and there's been massive talk about it. But the context is which rates are rising. Fixed rates have been rising for the last few months, but again, it's variable rates, so it's prime rate that has been going up, and it's variable rates that have been affected, not necessarily the fixed rates, although they continue to rise a little bit. But like Ed said, understanding what the article is saying in the context of the article and making it relevant to you is so important. And when there's a lot of times there's a disconnect between what's reported and what's happening on the street. So it really is important to talk to your mortgage broker, your banker, your realtor, to get a real understanding of what's really happening. And that it's not that all articles are wrong. It just they pick on certain things that definitely could put a little bit of concern or fear into people. So it's good to get relevant information, so that way it doesn't really bog you down and information overload, right?
Yeah, that's absolutely true. Factors that are affecting value. So yeah, location, we all know, I've heard it so many times. Condition of the home. It does affect the pricing. Like when you are looking at homes, there are homes that are not in good condition. The typical buyer is looking for like something like a kind of product that they can move in because they have extended themselves with what they can afford with the down payment, and they get the mortgage and whatsoever. So if the home is in good condition and they know that they don't have any expenses to renovate the home or to make any major changes, obviously they're willing to pay more for it. So that makes a difference in the price. School districts, very important. From the perspective of an agent who's helping buyers, I have clients that they're saying, I only want to buy in this school district, nothing else, nowhere else. And they're willing to pay extra money for it, just because, think about it. If you want to put your child to a private school, the price of that private school tuition, put that into your mortgage. Your home value is going to go up. Your child is going to go to an amazing public school that has no cost for you. And lots of people don't, even if they have the money, they don't like to put their children in the private school. So these are the factors that really affect the prices in the market. Of course, demand is playing a big role. In this market that there were like the last few months, we had so much demand, there was not enough inventory, they affect the value. The marketing price versus sales price. That's another important thing that I like to bring to your attention. You hear lots of things, that lots of noise around this thing, like, well, yeah, they sold like $200,000 more than asking price, blah, blah, blah. There was a time that was called asking price. Now we call it marketing price, because it's not actually what they're asking. If you give them that money, they will just turn their back on you and say, go home. That's not their asking price. That's their marketing price that they're putting. And it doesn't matter how much, like when public thinks, so, well, like, we see that price, and in the past 6 months, everything in this neighborhood has gone for $100,000 more than asking, then they just falsely think that whatever comes to the market is going to go for $100,000 or $200,000 more than what it is, which is not the case. So that's where it comes to you to work with a professional that knows what they're doing. When I tell you that I have been on the multiple offers, that there are 30 offers, to me, it's that probably 15 or 20 of those offers, if they had a good agent, they wouldn't have offered on it, because the agent would have told them, you're not going to win. They won't waste your time. That's the thing. The interest rates are really important. Then they make a huge difference in the value of the homes, in the prices. Mr. George, do you want to say something here on interest rates?
Definitely. At the end of the day, we're still at historic lows when it comes to interest rates. Okay, a year ago, we were at 1.5% on a 5-year fixed rate. Now we're over 3%, 3.25%. But in the grand scheme of things, it is still lower than the average interest rates that are really like 4 to 5%, which are the historic norms. So eventually that, if the rates do continue to rise, and it's not going to be like a straight line going up. So whether it's the fixed rate, so the fixed rates are determined by the Government of Canada bonds. So the bond market dictates the fixed rates. Variable rates are dictated by the Bank of Canada overnight rate. So two different types of rates, two different vehicles, and two different means of rates going up or down. So the bond market on the fixed rates, it's really supply and demand that's driving the yields on those bonds, which then drives the interest rates on fixed rate mortgages. But monetary policy is driving the Bank of Canada decisions and the rates it affects there. But rates still haven't impacted the values yet. It's to be determined. There's so much chatter out there about inflation right now, and we still have supply chain issues with all the COVID protocols that are still in place, and hopefully those will all start to ease up a little bit, which should, maybe bring interest rates down a little bit if inflation starts coming down as well. So it'll be this, this little up and down, up and down. Let's try increasing the rates a little bit, see what happens. Let's go down. And unfortunately, we also have the war going on in the Ukraine, still in its infant stages. Hopefully it doesn't last too much longer, but that still will play a role on economies and interest rates. So I think we're still going to stay in a low rate environment for quite some time. So I don't know if it's going to be a huge factor in the valuations of properties, but ultimately it could play that role. But for now, I think it's still at the bottom of the list, as it should be.
Great, thank you. Kimberly is asking about what's happening in Ukraine going to affect interest rates and mortgage rates as a question mark. Yes, it will. Like, if you look at what Bank of Canada said when they increased the overnight rates, one of the factors that they just brought up that they at least looked at, is not like impacting highly, but it was something that was considered, was the war in Ukraine and the impact of that, and then why they decided to increase that overnight rate 0.25%. However, they're more important. I mean, like, the war could impact the economy potentially too. But the way that the economy goes right now, and the way that real estate market goes, in order for the real estate market to get the kind of pace, like that pace that I showed you in that graph, like a 30% growth, is very unhealthy for everyone. Like somebody who might have to sell right now, not have to want to sell right now and cash out. They might be happy. However, it's not healthy for economy. It's not healthy for anything, any buyers or sellers. So in order to cool down the economy, the market, including the economy, is growing, they are thinking of having more interest rate hikes during 2022 to bring the market to something around normal, which is now the last 10 years. The average price increase in Toronto in GTA has been 10%. So if that 10% gets increased to like 30%, there should be some, they are working on ways to cool it down, basically. Now that's all, these are all artificial ways of doing it. The organic way of doing it is to increase the housing, and that takes long, and I don't want to go there. But anyway, I don't know.
Can I just add something?
Sure.
Because we talk about the effect of the war. I think the Bank of Canada basically said they're going to monitor to see the effect and the impact on the economy with the war and supply chain, and obviously the price of oil. So it could maybe slow down these rate increases by the Bank of Canada, right? So they did one, which they kind of had to do because the inflationary pressures were pretty intense. So they said, okay, we had to do something. I think we may see one more increase next month at their next meeting. But again, it's going to be this push and pull going forward, and really monitoring all these different factors that play a role in determining the rate increase or not. So if the inflationary pressures are still there, then they will continue to raise rates. So it's a wait and see. And there's so many different schools of thought out there, and there's analysts that everyone has their own model and their projections. But at the end of the day, once things start playing out, that's what will really determine any decision by the Bank of Canada. Again, supply for the fixed rates, it's the bond market during a time of crisis, which this is what's being presented right now. There's a flight to safety. Bonds is considered a safe vehicle, especially Canadian government bonds, right? So again, there's demand for them, right? And it's, although there's an inverse relation between the price of a bond and the yield. So the price of the bonds have actually gone down a little bit, and the yields are going up. So plus the Bank of Canada is divesting itself of all the bonds that they've been buying for the last 2 years from the pandemic, right? So they're kind of throwing it out into the open market now as well. So their quantitative easing is slowly coming to an end.
Awesome. Let's go to the next part, the home buying process. So I just have this chart here. Quickly explain. You might have heard some of it. Okay, so we're starting from the search, going to the viewing. We go and look at properties, and then we like a property. We fall in love with it, basically. Not to like it only, or sometimes we like it. It depends. Then we put an offer on it. What happens when you put an offer? There are 3 different scenarios. Number 1, which is hopefully we don't get there, is rejection. Your offer is getting rejected when the price or the closing or the terms are so much far away from the expectations of the sellers. They will politely or impolitely thank us for our offer and don't touch our offer. Basically, they just reject it. They said, no, you're not in a position that we can even give you a counter offer. The next would be a counter offer. The counter offer is when some parts of the offer are attractive to the seller, but some part they don't agree with. Majority of them are the price and the closing, or sometimes some conditions. And then they counter your offer, give you a new offer, and then you can reject, counter, or accept, and so on. And then last and the best part, acceptance is usually happening when the agents of the buyer and seller do their negotiations either on the phone or in person, and come to a agreed upon price, and then put it on the paper and they sign it and give it to the seller. The seller accepts it. And the other scenario would be in the multiple offers, when one of the offers is the most attractive offer to the seller and they accept it right away. So for the accepted offer, these accepted offers could be 2 different scenarios also. One is a firm accepted offer, meaning there's no condition in the offer. Both buyer and seller are bound by this contract. In the conditional accepted offer, the seller is bound. The buyer has a way out, by the couple of conditions that they usually have. One is financing, that Mr. George is the expert. The other one is inspection. You get the professional inspector to come and look at the house, and if there's any major problems that they cannot be rectified, then we can walk away from the deal. For the condos, there's another condition that's not here, but it's due diligence thing. It's the status certificate. That's a document that shows the reserve fund for the condo, shows all the possible lawsuits against condo, or the condo has lawsuits against other corporates, bylaws that are important for the buyer to know, and all of those. These are the conditions that usually we put for the buyers. And when those conditions are fulfilled, meaning that mortgage is approved, your inspection report comes with no problem, and your status certificate for the condos are having no problem, then at that time we give the notice of fulfillment to the seller, and both parties, both buyers and seller, are bound by this contract. And what's next would be you're waiting for your closing time to come, a month, 2 months, or 3 months, and then the funds are going to be transferred from your lawyer to the seller lawyer, and the property is going to be registered under your name. You get the keys. That's it. And then you move in.
Can I ask a question, Ed?
Of course.
My understanding is that, especially in markets like Toronto that are really hot, there are a lot of sellers that aren't accepting any conditional offers. So is there any way for a buyer in that situation to protect themselves against the risks of not getting financing, or there being a major repair in the home that wasn't obvious?
Yeah, exactly. Very, very good question. Okay, so yes, if you're working, let's say with me, I would never put an unconditional offer on anything that me and my buyer are both satisfied with all of those conditions. So meaning that we have to do our homework ahead of the time. When we meet with our clients, we make sure, like either with George, or they have their own mortgage broker, or they're dealing with the bank, they are 100%, not 100%, there's no 100% for anything. I always say, people say, do you guarantee this? I said, there's only one guarantee, and that's you and I are going to die. The rest are things are not guaranteed. But at least they tell us, like, 95% you're good with finances. 5% chances of something comes up, but it's good that when you're working with a mortgage broker, they just, they're there to guide you through all the hiccups or turbulences that you might face. But if you're 95% satisfied with your finances, if there's an inspection needed for condos, we don't usually, they say we do. I bought condos for myself, for my 2 sons, or any of my relatives. We don't do inspections, but it's up to the buyer. But if it's a house, definitely we need an inspection. So we will take the inspector, go do the inspection ahead of the time. That's going to be an expense for the buyer, but it's worth it. Even if they lose, they have to pay for the inspector. But I, again, highly suggest we do the inspection before we go firm. What else do we have? If it's a condo and it's a status certificate, definitely I will get the status certificate from the seller and give it to your lawyer to review before we say we are going to go firm. So everything that is a normal condition, we one by one, we need to do our homework for it before we say, oh yeah, let's go and do the full unconditional offer, and then something comes up and then you lose your deposit, which is not what, I haven't had that before, and I don't think I'm going to have it further. All of the conditions need to be satisfied for the buyers, and for me as the buyer agent as well. I don't go with no conditions unless I'm happy with the homework that we had done before.
Can I jump in for a second there, just to add a little bit to that? Obviously, to get to this point, we've already done our mortgage homework. We've done an application, whether it's a pre-approval, and I'll touch on the pre-approvals in a little bit, but basically what we try to do is, because we know that there is no condition of financing in most cases, but we do our best and we collect a lot of documents up front in order to find out what your circumstances are before you start making offers. And so we look closely at credit bureaus, we look closely at pay stubs, letters of employment, make sure everything lines up according to lender guidelines, because at the end of the day, even at a pre-approval level, lenders are not reviewing your documents. So we have to do our diligence up front to make sure that we're as comfortable as possible, that if you're going in firm, that it's a solid offer and that we've taken away some of that risk. At the end of the day, lenders can review a document afterwards, and when it's a live deal, and they may not like something, but we do a pretty good job in vetting everything in bank statements. And again, we do it all front end loaded. So that way, when it comes time to a live deal, we've already done most of the stuff that needs to be done. There's some cases where it gets a bit more complicated for self-employed people, but for people that are employees and they have like a standard salary, and whether it's hourly or they have commissions and bonuses, we factor all that in just to make sure that we are mitigating as much risk as possible for the offer.
Okay, so home buying process. These are things that if you were to go and buy, we will go through the details of it. But I can tell you here that you have two choices when you're working with an agent. You could be their customer, you could be their client. When you are a client of someone, they are obligated to you and you are obligated to them. And your interest is above everybody else's interest. Thankfully, in Ontario, the buyers can have representation and the agents are not the sub-agents, could be their agents, not the sub-agents of the seller. Obviously, if you wanted to choose an agent, you want to make sure that your agent is someone who knows what they're doing and you're comfortable with, and you trust them, you either know them or know them through the people that you know. Again, we can go over these things. So when somebody wants to buy, we have a more detailed presentation. We can go over the details. Next is one of the most important parts, which is the mortgage approval. And as George said, we do all of these works ahead of the time. I will leave this to Mr. George Colisaurus.
So going back to that slide that you were talking about, Ed, about being comfortable and working with whether it's a real estate agent as well as your mortgage broker, because at the end of the day, you're disclosing, especially to the mortgage side of things, because you're telling us all your personal financials, the good and the bad. So you definitely want to be comfortable working with people that you're in sync with. It just makes the process, it's a stressful process to begin with. So working with people that you can relate with definitely makes it a little bit easier. So, the application process can be overwhelming and daunting at times, but it can be exciting too, because so many times we've uncovered that you actually qualify for more than you thought. Sometimes people are using calculators online and don't realize, there's a little technical thing that they're not aware of, but we are as brokers, and just say, hey, congratulations, you can actually afford this much. And people say, oh my God, that's fantastic. The flip side to that is sometimes we find out that, hey, you know what, you're not there yet, but we put a strategy in place and make sure that, it's not going to work today, but maybe in 3 months' time or 6 months' time, or come up with some different options that may say, hey, okay, you know what, it's not today, but we have something to work towards in the future. So to me, that process is exciting. And sometimes it's deflating for people at times, but you know what, if we know that there's something good, we just work together and keep plugging ahead.
Well, what I got, George, is it's important to get that pre-approval, and it's important to know exactly what you said. One side would be you might realize, oh, I could afford more than what I thought. Or if it says like, well, you cannot get what you want with the money or the down payment and everything that you have, then it's going to be great opportunity for an individual to be coached and trained by a professional to get ready for this in a shorter period of time. You just not to wait for a long time and then come after 2 years and say, well, we could have done this, and speeded up the process.
It's Jennifer here. I don't think I'm ready to buy yet because I know my financial situation. But my biggest thing was being coached in how to get to the point where I am ready to buy, because I don't know. I know some of my numbers, but I don't know all of them. And I really want a place where if I want to only go down to one car for my family, then I want to be able to get to work without an hour and a half drive, especially with the way gas prices are going.
That's a great question, and that is part of the process here, is uncovering what we can and can't do. And when we look at all your numbers, you're saying right now you can't do it, but when you have someone else looking at it, there may be something there that's available to you that may actually make it a reality. But that's why in gathering the information, getting to know your circumstances, right, is so important. And I have no problems dealing with people that think that they can't, and just say, okay, well, maybe you can or maybe you can't, but let's have that conversation and see if we can make this a reality, or create a timeline to say, okay, this is how we can do it. Or we talk about options. Can we add someone on the deal that'll make it work, like a parent or a sibling? So it just depends on individual circumstances, right? And we customize it according to your goals and your circumstances. So don't think that it's not doable, in the sense that maybe it can be. And you may know something that I don't, obviously, but sometimes we've got some tricks up our sleeves as well, and people come out of there pretty happy.
Let's just give you a quick example. It was my own son. He studied economy, working for a great company, and and he was insisting that he cannot purchase. And I just sat down with him, and he just like, I couldn't believe it. So okay, there is possible. So anyway, but yeah, we can definitely help you with that, Jennifer.
Let's go to the next slide, Ed, because I'm sure there's going
Okay.
to be questions from the next
Sure.
couple of slides anyways. Okay, this one we've kind of already talked about in the sense that, getting to know you, the client, understanding what your goals and objectives are. Where do you want to live? How long do you want to live there for? Find out about, you want a fixed rate mortgage, variable rate mortgage. We educate you on that. Figure out your income levels, figure out your debt obligations, and then just start bundling it all up together into a formal application with supportive documents. Getting to know the goals, like Jennifer was just saying, I don't want to drive an hour and a half, especially with the price of gas. Okay, great. So let's bring it closer. What does that mean? What do we need to do? So again, that's part of getting to know the client. And as a former financial planner, I'm just more inclined to ask probably more and more and more just to extract that information, because the more information I get from you, the better the advice that I can present. We kind of talked already about fixed term mortgage, so I'll go pretty quick on this. So a fixed term mortgage basically means your rate and your payment are fixed for the term of the mortgage. And the terms go from anywhere from 1 year to 10 years. Okay, so that's kind of straightforward. Variable rate mortgages, which are obviously highlighted in the media today, is a payment that is determined by the prime rate, and they usually have a discount to the prime rate. So an example is prime minus one. Prime rate right now is 2.7. It was 2.45. So you get a 1% discount. Your rate is 1.7%. As the interest rate, as the prime rate changes, depending on who you go to as a lender, if you go into a variable rate mortgage, there's a few lenders that keep the payment the same, and all that changes is the proportion of principal and interest that changes when there's a change to the bank. Otherwise, the payment will go. So if there's a quarter point increase, which is the normal increase by the Bank of Canada, then your mortgage will go up. So in the media, you've probably seen a lot on Facebook and social media, approximately for every it's a $13 increase in payment for every 100,000 of a mortgage. So $500,000 mortgage, $65 a month increase. Not a crazy amount, but if it becomes another 65 and then another 65, everyone has to be aware of those numbers before they decide what to go in. There is a big gap still between fixed rate and variable. So I'm a proponent of variable rate mortgages because two reasons. Prime rate is dynamic, so it will come and go. It'll go up and down. And the other advantage with the variable rate mortgage versus a fixed rate is the penalty. If you decide to make a change or want to buy a house, or there's a better opportunity somewhere else, the penalty to get out of a variable rate mortgage is only 3 months of interest. So it's not a very expensive proposition. Whereas in a fixed rate, say you're in year 4, you could be looking at around a 3.5-4% penalty in your mortgage, in your penalty to get out of that mortgage if you had to. These are the types of things that we talk about anyways when we're ready to put a deal in. So it might be a little bit much at this stage, but again, being aware of what your options are, I think is beneficial. Okay, mortgage numbers. So how much income do I need to qualify? So right now we have, I guess since 2018, the stress test was introduced by our government and the regulators. And what the stress test was meant to do was to protect borrowers, because we were qualifying everyone, let's say at 3%, whatever the rate was at the time. Government came in and the regulators came in and said, well, we're at historic lows. We were still at historic lows back then. And what happens if the rates are going to be back to normal rates at 4 or 5% at the end of the term? We want to make sure that borrowers can handle that increase in rates. So I think that idea was healthy, because it did create a little bit of a buffer of protection for the borrowers in case we were in a rising rate environment like we are in right now.
And the lenders.
And the lenders for sure.
Yeah.
Right. So the downside of the stress test was that it reduced your purchasing power by around 20%. So it was a little bit of a trade-off, but obviously the market adjusted accordingly and, just kept on taking off. So the actual number, so for a $500,000 mortgage, and, at the end of the day, when you do a mortgage calculator, it doesn't factor in any property taxes, maintenance if it's a condominium. There's a heat component as well in our qualifying number. So in this case here, I've added some of those costs so to make it as realistic as possible. So for a $500,000 mortgage, you need approximately $100,000 of income. So if it's one person, is it doable? Might be a little bit harder depending on one's income. If there's two people, it becomes a lot easier. Now, so obviously, how much do I qualify for is one. How much are my monthly mortgage payments? So high ratio mortgages, which for most part, most first-time buyers are putting down less than 20%, which is considered a high ratio mortgage, which requires that you have to pay mortgage insurance to, there's three insurers in Canada. There's CMHC, Canada Mortgage and Housing Corporation. There's Canada Guarantee and another one called Sagen. That mortgage insurance premium can be added into the mortgage, but we'll talk more about that in a sec. So putting down less than 20%, the monthly payment is approximately $475 for every 100,000 of mortgage. For a conventional mortgage, which means you're putting down more than 20%, the payment is approximately $420 for every 100,000 of mortgage. Do we have any questions on that stuff?
This is not a realistic, like 500,000. I have not seen on any posting on anything, unless it was like a pre-construction first phase, possibly, and that's a condo. So when you're saying 100,000, are you looking at
per
like,
100,000? Sorry, you're talking about the income right now?
yeah, $100,000 worth of income.
Okay.
Yeah, because these houses are selling, and when I hear, oh, it's like $400,000 over the asking price and blah blah blah. So now we're looking at like 1.2, $1.4 million.
Right.
So with that in mind, now you're looking at maybe $250,000, $300,000 as a household income. What I'm seeing is that I'm seeing a lot of like families pulled together and buying one house and making it like a multi-family unit, because this is getting out of hand. So if we're going to do that, and say if I have my family and I say I have Kimberly's family, I have Jennifer's family, and we're all pitching in. So all our combined thing has to equal something that'll be good for a down payment of the 1.4, yes? Or does it has to be one person? Like, how does that work?
Well, we'll talk about the down payment shortly. The income for sure. The rough number is for, like, you talk about something about 1.2 million, so it's conventional. So you need minimum 20% down, but the payment is around $17,000 of income for every 100,000 of mortgage. So 10 times it's $170,000.
Yeah, for the entire household.
Household.
For a purchase of 1.2, you need $170,000 income total, accumulate.
But you got to keep in mind, that's just a pure mortgage number, right? Because then there's property taxes and maintenance. So it'll be closer to the $200,000 range of combined income, whether it's one family or two families, whoever is going to be on the mortgage. And there's times where we have 4 people on the mortgage. There's times where it's a couple, and then we're adding parents on the deal as well to qualify for the income. So sometimes you have the down payment, but the income levels aren't there yet. So we look at what can we do? And I guess this is the segue into this slide. Chatting away here on down payment. Okay, so the traditional minimum down payment is 5%, but the government's made some changes. This was to protect more CMHC than anybody else. So basically, it's 5% of the first 500,000, which is 25,000, and then it's 10% for any amount above 500,000. So I gave an example here. Again, probably a little bit low, but it's just for mathematic examples. So a property value of 700,000. So it's 5% of the first 500, which is 25,000. And then we're 200,000 above the 500,000. So it's 10% of that 200,000. Is it 700? Yeah. So it's 20,000. So we need 45,000 of down payment. So, and I use it's actually 750. So I used property value of 700. So it should be 750. So it's 250, 10% of the 250,000, which is 25,000, 25,000 for the first 500,000. You need a down payment of 50,000 for a $750,000 purchase. If you go over $1 million, over $999,999 minimum down payment, regardless of lender, regardless of anything, it is 20%. So if you go to $1,000,001, all of a sudden you have to pay 20% down payment. Take it to 999,000 and you go into the scale here. So, and then we've had that, we've actually had to go back and change the purchase price to bring it below 1,000, because I go like, okay, guys, for the sake of $5,000 or whatever it was in this one particular case, it makes no sense. Figure out a side deal. We need 999,000 on the purchase agreement. Does that make sense? So, you say, okay, where do we get the down payment? So you look at the price of homes, you look at the size of mortgages, and everyone goes, how on earth is everyone qualifying for these things, right? And basically, there's, down payment sources. You have Bank of Mom and Dad, you have your personal savings, and
Ed's money. We have Ed's money, right, Ed?
We got Ed's money.
Thanks, Ed.
Yeah, of course. We can rob the bank. Come over. Let's go.
let's go back to the down payment sources. So first one obviously is personal savings. Okay. First-time home buyers have the advantage of being able to withdraw up to $35,000 from their RSP per person. So that's a good source. The good thing about that particular program is when you withdraw that money from your RSP, there's no withholding tax. Basically, what happens is that a year, I think it's like 2 years after you close your deal, you start paying back 1/15 of that amount every year. You contribute it back to your RSP. So they give you 15 years to repay the amount you've withdrawn from your RSP plan. If you miss a year of contributing that dollar amount, they will treat that income that year as income for you. That missed payment will be treated as income, then it'll be taxed. And then you just continue on from there. So obviously, if you are going to use the RSP as a down payment, then you got to be mindful of the repayment. So pros and cons to using the RSP as your down payment. The pro obviously is that you can use the down payment amount without any taxes. The disadvantage is that you've taken that money out of the market now, which could potentially keep growing if it's invested in a aggressive portfolio or a balanced portfolio. So you're foregoing that growth. But the reality is most of us need to tap into anything we can to make it work. Gift from a parent or family members, it's become very, very popular. Bank of mom and dad, and it's a reality. Some are fortunate enough to be able to have that type of help, and some aren't. For those that are, they're fortunate. We make it work. For those that aren't, we try and figure out what other strategies can we come up with. And the one strategy that no one really talks about, and it's a great opportunity. So there's people that have fantastic incomes, right? But they're relatively new in their careers. They haven't had the opportunity to save enough money over time, but they can actually do what they call a flex down, which means you can actually borrow the down payment. So you go to your bank, you get a line of credit. Once you figure out how much you need, that's the easy part. The biggest part is making sure that that debt obligation, that payment has to be factored into our overall qualifying ratios when we do the mortgage qualifying numbers. So it may reduce a little bit of your purchase price, but it does potentially get you into the market. So there are people that have strong incomes, whether it's when they come out of university or 2, 3, 5 years into their career and they're doing well, but I still don't have $100,000 or $200,000 saved up yet. Well, let's look at that option. So that is a bonus. Not every lender does it. The banks generally do not do the flex down option. That's offered through mortgage brokers, and we have these large financial institutions that are called mortgage finance corporations, and they offer these programs. So you'll go to your bank, but you can still use it through these guys as well. So that's an option as well.
Very attractive option. And how are they rates? Are they normal banks rates or are they higher?
Well, the rate you're going to get, it depends on the facility you get from your bank. If you go to the bank and get an unsecured line of credit, say for $25,000, $30,000, they're going to charge you like an unsecured line of credit probably around prime plus 3 or 4. It depends on your overall credit score as well. Any other debt obligations you have. Again, it's not an easy way
What
of
I'm
doing
not
it,
talking about sorry to interrupt, but I was not talking about the line of credit portion. I was talking about the mortgage portion from the
standard rates. Standard rates.
Okay.
Yeah, there's
like
no
competitive
premium.
rate. Okay,
Yeah,
good.
it's just like having your own money. There's no difference there.
Okay, got it. Thank you.
And one of the last ones is the first-time home buyer initiative. Not a very popular program. I'll be honest, I've never done one. I'm not a big proponent of it, and 2 reasons. One is you're a partner with the government. Me personally, I don't want them involved in my affairs as much as I can avoid it. They'll lend you 5%. So you have to have your own 5%. Then they'll lend you an additional 5%. And they call it interest-free because there's no payments being made on it. But technically, there is a cost associated with it because if in the future you sell that property, they take 5% of the growth. So if you buy property, again, I'm just going to use easy numbers, Rebecca, right? I'm going to use cheap numbers, right? So 500 that you buy a house for 500,000 and then you sell it for 600,000, $100,000 gain. The bank gets their 5,000 back plus the $5,000 return. So interest free, don't think so, right? But it does help some people. The other problem with the program is there are some limitations. So in the Toronto area, maximum combined family income is 150,000, and then your purchasing maximum purchase price is 4.5 times that dollar amount. So 4.5 times is 675,000. So again, kind of limits you in the Toronto area. For some people, it is an option. It's something that, we talk about what can we do? What are our options? This is the kind of stuff that we look at. At the end of the day, guys, when we do our application, we look at all these options. We look at what strategies are available to us. I can tell you for those that are fortunate enough to have more than 20% down payment, well, then we can look at other options. We look at credit unions because the credit unions are regulated by the province, not by the federal government. So they don't have to do the stress test. So we can get qualified at the contract rate, which now increases our purchasing price. increases our borrowing amount. So some creativity is still available to us. It's based on individual circumstances. So there's no cookie cutter here. Even for AAA clients, there's no cookie cutter anymore, right? It's put it all down and let's see what works.
Hey, so Georgie and I have chatted before, and I'm a single household on one income, and I was just wondering, is the mortgage approval based on the gross sales? Because that would really make a difference.
So
Or is it on the net profit?
You're self-employed, right?
Yeah.
So there are some self-employed programs out there, more really on the conventional side, meaning more than 20% down. But there are some even what they call stated income programs on the insured side, but you have to have minimum 10% down payment for those types of programs.
Okay, so when you say conventional, if your gross profit is 100K, then what type of down payment would you need on a conventional?
You have to have 20% down if we want to kind of say use your bank statements just based on your deposits. So there are some, pretty creative solutions out there. It's just a matter of where do you fit in that matrix.
Yeah, I think that's the thing that I've been hearing. Like someone told me, well, I need to show bank statements of making, $8,000 for a consistent 6 months in a row.
Yeah, we look at 6 months, right? And it depends on the field that one is in. We have to make some assumptions for some expenses. And then, we come out with a net number.
Because the whole point of being an entrepreneur is to write everything off. So our net income, we try to get it down as much as possible. So then it's like, well, how can I prove that I'm generating this much income if that's what being looked at? So anyways, it's a conversation we can have on the side.
These are good points though, because for those that are self-employed, you somewhat get penalized, right? Like you said, I'm self-employed, Ed's self-employed, and I write down my income as much as I can, like you said, so that at the end of the day, though, if you go to, let's say, a B lender or an alternative lender that will look at your bank statements, they may charge you a little bit higher interest rate, but it's a lot cheaper to give it to them than it is to give it to the government. These are very popular programs. We're doing more and more B deals, let's call them. They can get pretty tricky though, but I've done some pretty creative stuff where you just sit there and go like, oh my God, that was awesome. And I just did 2 recently. One was for a lawyer and one was for a general contractor. And we worked those deals because they go through almost every line on your bank statement and they go like, what's this and what's that? It's just like, oh, you're killing me.
Yeah.
We were able to get them done. So there is still hope out there. And when all these changes started in 2016, 17, 18 to try and cool down the market, the lender started getting creative and saying, okay, here's that box. We got to be able to walk on the outside of that box a little bit. And they were given the blessings too by the regulators and by the government.
There's a question in the chat.
Having high investment balance helping qualifying for a mortgage. So lucky, it really depends on how high, right? There are some high net worth programs out there. Just to give you a version of one, you take your income that you declare. They say, okay, lucky qualifies for a $300,000 mortgage, but Lucky wants a $700,000 mortgage. If Lucky has an extra $400,000 in his investments, they will give you a mortgage based on that. You don't have to cash out your investments. They know that you're good for it because you got the money sitting on the sideline. So there are some versions of that as well. Okay, so closing costs. Ed's going to go into a little bit more detail down below, but basically outside of your down payment, you also need to have 1.5% of the purchase price available for closing costs, which entail land transfer tax, legal costs, not moving costs though. Moving costs are not part of your closing costs. They are an actual closing cost for you as a buyer, but it's not included in the 1.5%. The 1.5% is basically land transfer tax, any adjustments, title insurance, and pretty much it, to be quite honest with you. And the last point that I have is first-time home buyers tax credit. You've now bought a house, you moved in, and now it's time to do your tax return. So you bought a house in 2022. Next year you go do your taxes. You can claim a $5,000 non-refundable tax credit, which will equate to a rebate in your taxes of around $750. Not a lot, but it's better than not getting it. Recap, guys, of advantages for first-time home buyers: the ability to use your RSP for your down payment. You get the tax rebate. You have the flex down option for the deposit. Those are pretty well the main points. And then, you also have the land transfer tax rebate, which I think Ed's going to talk about down below as well. So you get to save $4,000 with Ontario and $4,400 with Toronto. So $8,400 of potential rebate. Sorry, let me just say one thing. If we have to use parents to go on title, we'll register parents, or the lawyer will register the parents at 1% ownership. So this mitigates their exposure to capital gain taxes in the future if and when you decide decide to sell the property. We use their income, take the 1%. It keeps 99% of your land transfer tax rebate in check. So again, a great strategy, assuming bank and mom and dad can help, because we also have to take into consideration mom and dad's obligations as well, debt obligations. So again, part of the strategy, one of the things that we look to talk about when we're putting an application together.
Hi. So for that, the first-time home buyer's tax credit, does that have to be split between, like, does the $5,000 split amongst everybody if you're buying with multiple people, or can everybody claim $5,000?
No, it's split. It's not for everybody.
Okay.
Yeah.
And for
The government's not that nice to us.
for borrowing from the RSP, is that the same thing? The max amount that you can take out from your RSP, does that have to be split as well, or can everybody
No,
take
that's
out?
per person. As long as everyone is a first-time home buyer, and first-time home buyer basically means you haven't owned a property in the last 5 years.
Let's go to the next part. Let's go shopping. When you go for shopping, these are my suggestions to people. Keep an open mind. You go to a property, you see a property, do not allow the look of the property to fool you. How? You go to a property that is tenanted, the tenant might not be interested in the property to get sold. I've seen so many properties with, underwear on the floor, the cat litter is left there, you open the door, it stinks. Look and think beyond all of these pleasant or unpleasant things. Or on the other part, like this could be all done. Imagine all of these are going to be gone. The houses, you're going to paint the house. You need to use your imagination. The other way around too. Nowadays, me as myself, as a listing agent, I do the same thing, and I have to, this is my obligation to my seller. I have to make the house look really good. So we do staging. Sometimes there's like a little alley that we call dining room, and we have to find a very narrow dining table to fit in there. And everything is nice and cute and good looking. And you walk in and you don't realize that, well, that dining table that is there, it's not really a dining table. It's like a narrow thing that is shoved in there, and then later on your dining table is not going to fit. What I'm trying to say is that look beyond what is being seen. Again, location cannot be changed. You can change the bathroom, you can change the kitchen, even if you don't have money for doing it, you can do it later, but you cannot change the location. So location is very important. But location. I'm fed up with it because everybody said it, but it is important. And viewing properties, again, when we wanted to go and see homes, I can coach you on that. One simple thing is that, let's say if you go to see a property and the owner is there, first of all, if you have any questions, you just address it later, ask me later. If you fall in love with the house, just be a poker face. You just, like very nice home, and they don't say, wow, oh my God, I love this house. Like, let's just buy it. And then it's going to make my job hard to negotiate the price. Let's go to the next part, which is making an offer. I have already went over this, just like go quickly in this. Price, closing date, deposit, conditions are very important. Price, I will tell you what I think the property is worth it. Even if we go to the multiple offers, I tell you what is the max we should go for this. If it goes more than that, good for whoever wants to put a crazy price on some property, let them have it. We are not having it. Closing date. It has to be something that is suitable for you, of course, but we try to work with the sellers on the closing date so we can give something, so get something. We give them the closing date if it works for you guys. For the buyers, we give it to them so we can get a better price from them. Deposit needs to be cash in your account, 5 to 6% of your maximum purchasing power, whatever you can purchase. 6% of it, make sure it's in an account that is always accessible. Why I'm saying that, some younger generation people, they have the money in some financial institutes that they don't have a branch on the streets. And when we want to get access to the money, it takes 48 hours to get it. And if it's a multiple offer situation, everybody else is going to beat us because they have the cash. So that's quickly about that. Buying costs. Okay, the lawyer costs. These are the costs. Majority of these are not going to be included in your mortgage. That's why I'm emphasizing on them. So you want to know that 1.5% that George was talking about, what are these included in? A lawyer cost is between $1,500 to $2,000. Could be some more or less, but this is just a rough idea. The status certificate is $100, nothing, but I usually put that on the seller to pay for it. CMHC, sorry, I'm rushing to finish this. That you guys, I know it's late and you guys want to go. This is the insurance for the mortgages that are being less than 20% down payment. So it varies based on the percentage of your down payment versus the purchase price. It is, George, can you give us a very quick rough number for imaginary purchase?
Again, just go with 5% down payment. It's 4%. The premium is 4% of the mortgage amount. $20,000 mortgage insurance premium, which gets added into the mortgage. So now your mortgage would be 520,000 as opposed to 500. And then they charge the provincial sales tax on that 20,000. So it's 8%. So it's $1,600 of sales tax, which cannot be added to the mortgage. It has to go to the part of your closing costs.
This is the only item on the closing cost that not all of it needs to be paid in cash. The only thing that's paid in cash, like on top of your purchase price, is the PST, provincial sales tax, on the premium of insurance. Insurance premium is going to be added to your mortgage, so you don't need to have extra for that. Appraisal fee is around $300. Some banks will charge you, some won't. Title insurance is very important. Everybody needs that title insurance. It's $600. Property insurance, again, any financial institutes wants to give you a mortgage, they are looking for the insurance on the property. So it's going to be $500 to $1,000 per year. Home inspection is around $500, and mortgage adjustment period varies. Is this going to is it going to be cash? Yeah, it's going to be cash. So how much?
So I'll give you a quick explanation to that. So basically, let's say your mortgage, your transaction happens on the 15th, for argument's sake, but you want your payments to come out monthly on the 1st of every month. So from the 15th to, or I guess the 16th to the 30th of whatever that month is what's called an interest adjustment payment. So it's just 2 weeks of interest. So on the first of that month, after the 2 weeks after that purchase, that first payment on the first of the month will be just interest, 2 weeks of interest. Then the following month, the first of the following month will be your first mortgage payment, including principal and interest.
That's not significant. So it's nothing to be too worried about.
No, it's not. It's not a cost. It's not a cost.
So the highest cost that you have on closing is land transfer tax. And as like it has a complex, kind of like complex, not too complex, but anyway, I'm too lazy to do calculation. I usually go to my website and I go here. You can go to my website, it's torontorealestatemarket.ca. Put an asking price here. So what price should I put?
$750,000.
So let's do 750. Okay, let's go. So your land transfer tax, if you are not a first-time home buyer in Toronto, would have been $23,000, and you need that cash. But look, that's gonna drop down to 14.5. So it's almost half. For the first-time home buyer, your land transfer tax for a $750,000 home in Toronto is $14,475. Now, do you want it to be cheaper? You go a little bit out of Toronto. Let's say Thornhill, which is like Toronto, right? That's going to drop to 7,500. So anything in 416, the tax is almost double of 905. Land transfer tax is one time paid. Toronto's land transfer tax is high, but when you are living in your home, the annual property tax in Toronto comparing to the suburbs is less. So in the 10-year term, you will break even. If you pay this high amount in Toronto, in the 10-year, it's going to be the same as if you were paying a smaller amount upfront and then paying more annual taxes. But these are the reality that you want to be aware of. These are the things that I want to make sure that whoever is leaving here, they know all of these expenses, and not to be discouraged, but you just see what the reality is. So 7,500 for the first-time home buyer. Again, if you were not a first-time home buyer, you would have paid 11,000 and change. So this is one of the advantages. The bigger purchase you have, the bigger savings you will have on the land transfer taxes. Okay, so that's the land transfer tax. Our next slide would be our contact information.